mastermind, and it goes through everything to do with finding, buying, acquiring multifamily. It's a pretty cool 2 days.
Yeah, because I had
Yeah.
like Total Wealth had like a bus tour the week before for like one of Sid's
Okay.
properties, and then they're like, hey, can we switch to the 23rd? And I was like, no, I got to talk to the guys at Mansa first. I've already told them first I'm doing it, and I was like, I don't know what I'm doing yet, but all I know is told them yes, yes, include me.
We're on YouTube right now, right? It's kind of cool.
Yeah,
Yeah, I tried YouTube today.
What? Sounds good.
cool.
YouTube Live will be fun. From Facebook Live, we went to YouTube Live.
As long as we're alive.
Yep. Sanjay talking to the prep guys right now. I think I hung up on that when I left.
Do you want to start letting folks in?
Yeah, why not? Let's do it.
Hey, Candace.
We have one closing coming up this Friday, hopefully.
How are you, Val?
Hey, good. How you been?
Real good, thanks.
All right, we only have a few, but I'll let them in. Welcome, everybody. We're gonna give it a few minutes, let some folks join us. Thanks for coming on a Wednesday evening. It's great to see everybody here. You don't usually have your camera on. I feel honored tonight.
I just wanted to say hello.
Good to
How are
see
you?
you.
Good to see you too.
She's my biggest fan on Facebook.
Yes.
Every time I post something, I get a like. It's awesome. Thank you.
Everyone's saying she's awesome. Point taken. We agree. That is good. We don't have music. Where's Maria? No music. It's kind of like, we should have some music to it.
You're real low volume as well again.
Okay. All right. How about this now? Better?
It's a little better, yep.
All right. I hope it works out. I'm getting a new headset. It's on my way. I know that for sure. Okay, let's get a couple of more minutes, then we'll get started.
Awesome.
And
Yep.
we are live on YouTube today, thanks to Mike.
It's good to be alive. Wherever you're alive.
Hey, that's a blessing. We take it one day at a time, right? I saw one of my friends today. She was texting me. We were just talking. She's at the Olympics watching the games. That's kind of cool. I saw some of the cool pictures.
Yeah, she's there. Janae goes next week.
Oh, cool. That's awesome.
Yeah. Awesome. You want to get rolling?
Yep, let's do it.
Awesome. All right. Welcome everybody for the Massive Masters Wednesday case study. If you've been living under a rock and you don't know, we do this every Wednesday. We start at 6 o'clock. We always try to do a case study for things that we hope that people will find useful and educational. This one is always one of our usually most well attended. So it might be summertime, everybody's away. But when we talk about the tax planning, it's a very important topic. And I always preface it by saying it's not how much you earn, it's how much you keep. And so real estate is the best way for you to be able to do what you can for keeping your money. So this is an educational series. Normally we don't have any professionals, but tonight we have one, but he's not your professional. So you still need to make sure that if you're going to make any investment decisions, that you seek out your own professionals, get your own advice. All investments do have some risk. So we have a bus tour. Do we know when the bus tour is? It keeps getting, see, when you get a hurricane in Florida, you can't, or sorry, Houston, you can't go out in buses.
That's true. It's being finalized given the 23rd that we have. Probably it's week after 23rd, the 1st of November, probably. Yeah.
Awesome. Okay, so we will have a bus tour coming up, so stay tuned. Make sure that you're connected with Massive Capital on social media. This is also a must-see event. All right, if you're anywhere in the area, you need to get yourself to Houston, Texas for August 23rd and 24th. We've been doing our master classes and we've been doing one day here, one day there, moving them around. And we've come to the conclusion we need a 2-day full intensive. So it starts Friday morning, 8 o'clock. We do have coffee. And then we go through everything from how do you figure out your buy box? How do you find a deal? What do you do? How do you look at a deal? How do you underwrite a deal? How do you make an offer? How do you start raising capital? What are all the steps? And then once you get the property, the real work begins. So we spend a whole session on how do you set up your asset management? What are the things that you want to look at? How do you implement your business plan? It is an amazing 2 days. We don't make any, we lose money putting them on, but the idea of it is to be able to give people a real hands-on experience where you can actually learn everything that you need to know in 2 days to get started.
Just to add a little bit to it, we designed it from backwards, which is what happens once you own an asset, or what happens when you invest in an asset. What should you expect, right? And then we kind of back that forward. So if you're an LP, you want to see the whole 360 view of it, come on, join us. If you're a general partner, trying to start from the fund management side or asset management side or something in between on the acquisition side, there is a lot more that goes in it. And our goal is to do almost like your B school immersion. It's 15-20 minutes of the idea, introduction of the thoughts, then 45 to an hour and a half of simulation. Get your laptop, go through the process, pull out the contract, do some simulation, make the offer, then you go run it. It's pretty intense. But we're looking forward to have everybody joining us. So if you're in town, please come and join us.
Yeah, it's a great day. All right, so tonight's agenda, we're going to talk about current activities, our value add for investors. Tonight's case study is tax planning. And Sherrard's getting good with these funny little images, right? A tax-free fund. That isn't something that I've seen in a long time. So, and then we'll always have plenty of time for Q&A.
Trying to get some jokes out of it, right? I mean, I was
know.
a corporate employee forever, and that is right. And when I came to real estate, I was like, makes a lot of sense. So
Awesome. So Massive Capital itself, we're a vertically integrated real estate company. We're a developer of triple net retail and town centers. We're owner operator of value add multifamily. You can look at the map. We're very Texas focused, but we do have 2 assets in Denver, 2 in North Carolina, 2 in Atlanta, Georgia. Tampa and Phoenix are there because we looked at retail developments, but it didn't end up happening. And between our partner, Realty One, which is on the triple net retail lifestyle center, we have about $500 million in assets under management. And on the other side, so we do equity, fund, brokerage, again, all on the triple net retail, property management there, development, construction. And then we have our Massive Masters. So if you haven't heard anything about the Massive Masters, our goal was to create a mastermind where you learn by doing. Big difference from learning and just saying, well, go off and hope you can execute your plan. So again, this 2 days is a great way to be able to do it. So since 2022, we've done 15 projects. They've included land development, value add multifamily, and triple net retail construction. I almost stuck a picture in here, our retail development, but I couldn't get it to fit nice. It was going to end up in the water in the pool. But we have a 16,800 square foot retail development here in Austin. I went and got a picture on Sunday. We're going vertical. I'm super excited. It looks just like the drawings on only a steel structure. So super excited about that. We still have some room remaining on our value add opportunity in San Antonio. And we have a webinar coming up. So we'll talk a little bit about that in a minute. And then we have property that we're just about to close in West Texas. We have another one under contract that's going to start out as a 506B, a retail in Katy. And then we have an LOI accepted on a very large property in Houston. So we're super excited. We've got a lot of things going on. Very excited about it. So we do have our update webinar for Horizon. It's going to be on August the 6th at 6 p.m. This is a really good time for you to come and learn, how do you implement a value add multifamily plan? What do we do? Where are we in the project? This is currently a cash flowing property. It's a great property. We do have a bonus if you're interested in a large investment. We're super close to finalizing the raise. This one comes with a projected equity of 2.11 multiple of your money. So to make sure, for those who are new, you give us $100,000. Our goal is to give you 211 back in 5 years. That works out to an 18% IRR, which is an internal rate of return, basically the time use of your money. It comes with a 7% pref. What this means is, us as sponsors of the deal, we don't make anything till you at least make 7% on your money. This accumulates so through the lifetime of the deal. And tonight we're going to talk a lot about those amazing things called tax advantages for real estate investing. It is the secret sauce for keeping more of your wealth. And I put a link in there to join the webinar. Sharar, I'll let you go over. You do a great job on the learning by doing.
Thank you, David. I'm sorry. Thank you, Trevor. I was talking to David for an hour
You've
and a
been
half
doing
before I got to
David
this
all
call.
week.
I'm
You've been
sorry.
at
I'm sorry.
webinars with David. This week how many webinars have we done? Because we have 15 deals. One of them we did on one webinar where we put the 3 development, but we've had a lot of webinars this week.
Yes.
So,
Yes.
And one thing before I go, I'm going to put the link in here. If you're running a bit late, we do put all of our educational series on our YouTube channel. So I'm going to share the link here. Be sure to sign up. That way, anytime we add any new content, you're not going to miss out. So awesome. Let's
Trevor,
go.
thank you. And sorry, and I called you David. I had a call right before this call. I have another call right after this call with David. So in my mind, it's David all day today. So hey, on that note, from our philosophy has been we share what we do and what is working for us, what is not working for us, what we're observing, and that's the foundation of all of our things, right? Because we are learning, we're growing at the same time. Market moves. Oftentimes, sharing information is the best way to do it, where we're involved, right? Otherwise, and we just don't want to share that we think this is better versus that, where I don't have enough data point, or I'm not in that, or Massive is not playing in that court. So we try to shy away. Long way of saying most of the thing that we talk about here is coming out from what we are working on. Example, the capital raising, tech stack, or all the works that we do. How does it point out? Since last year, we underwrote about 1,200, 1,300 properties almost. I'll round up. Last week, I updated this one this week. Last week, we were at about 1,270-ish. So we went up a little bit, and about 145 deals that we have inside the pipeline right now. The Q3, Q4 pipeline is full. We're seeing a lot of properties coming back on the market. We're seeing a great amount of calibration where the sales expectation has set. And also the push came where we're seeing the sellers come into the plate and trying to execute as much as they can. So the pipeline went up a little bit. So the bottom side, Q3, right now it's about 90 deals that we have. It's the 55. So we're expecting quite a bit of an uptick. So what we're doing is that we underwrote a lot of assets. We collect a lot of data. Right now we're throttling down a little bit to make sure that we're looking at within our buy box. So we have narrowed down our buy box, and we're looking at the deals that fit into our buy box. And that means that fits into the investment requirement that we have. And on the right side, it shows our what's going on. We have 3 partners review. That means we have to decide whether we push the contract or not. We have 3 LOIs are pending. We have 8 under detailed. Also, what it also means that if you are a general partner and if you're coming into the play, understand 1,300 properties, you just cannot humanly write in the tech stack. If you're an LP, you are looking for a team that is actively involved in the deal, right? Because unless you are not in the lane, really, deep into the whole work process, you kind of sort of don't have a clear view of it, right? So we do everything by our tech stack. So we have Monday.com, all of our workflow and process. We use Monday. It's heavily customized for us. We brought in acquisition workflow. We brought in our contract to close workflow, and a bunch of other workflows are there. So it's heavily decked out. We also use RedIQ. That is used by mostly the high-end hedge funds, So we brought that in for us. So we bring in all of our data set into RedIQ. That gives us our own database as we have. In other way, we have 1,300 properties, actual performance information within our database that we capture, that we use for our underwriting. We also use Client Harbor. That's the platform that we use for all the communications. So all the text that you all had today at 2 p.m. went out from Client Harbor. Our emails and everything else goes out from Client Harbor. And Skyline Title is our strategic partner for all things closing. We know the owner, and from a massive team perspective, from all the closing, we want to have a validation of the workflow and the speed of it. And so from all of our team, we are going to Skyline for all the closings, residential, commercial, and anything you have, call it. All right, so for us, and again, and our philosophy has been from day one, we grow together, and we like to do a lot of partnerships. So as of now, in our buy box, we are buying lands. We do acquisition, off market, Class A only, retail, JV development, again, Class A only, 10 to 40 acres. Those are larger town center development, that type of product. We have one that's went under contract. It's like a floating right there, and that's a Class A development in Katy area. And we have another one we're engaging with the seller. It's a large family office, and they're going to pitch in probably a $17 million land as a LP. We'll bring in the balance sheet and the construction and also the lease up. So that's one. So if you have a land, anybody that you know in a Class A location want to push that forward, we can strike a partnership as we go. Second one is multifamily. New acquisition, it's 80s vintage, 90 and 150 plus units, pitch roof, no coastal areas. Our philosophy has been we don't want to get caught into the insurance and tax increase, and especially insurance increase. David, Trevor was mentioning about the Florida market, so that's one of the reasons we're staying out the Florida market, especially on the multifamily side, because we believe there's another cycle has to go through for insurance to catch up. We provide also KP support for the non-recourse loans. The only time we'll take a recourse loan is only for us. So the project I was mentioning, that 6 acres in Katy area, that's about $17 million loan-ish. And us, Massive and R1, will take the recourse loan for our deal as you go. So we feel the deal is good enough to take a recourse loan. Asset advisory, wherever that we come in as a KP, we also bring in our asset advisory part. We have our own software, own dashboard that sits on top of the PM. So we brought in like a Fortune 5 framework, how to run an asset via the framework. So wherever we go, our asset framework goes with us. That helps us stay close to the property without being at the property. And then everything rolls into the Massive Masters that we have. That's there. So we get a lot of questions. What does Massive Masters do and how they add value? So our philosophy is, look, life is already tough and life isn't fair. And the question is, how many of those unfair things can work on your side? And that's where we are at, right? So typical philosophy is that you go, you learn, then you go build relationship with the brokers and the vendors and the property management company and figure out underwriting. For us, you don't have to do that. We already have a relationship. We already have a deal flow. We have a tool. So by design, you're ahead, and then you run with the rest. So for us, as a part of the Massive Masters program, is you have completely access to our deal access, and we are running, me, Sanjay, Mike, Trevor, everybody, we're running shops. We are building the bridges, and so that when we buy an asset, we are not competing on the price only. We can compete on the other side, know-how, and asset management, then CapEx, equity, debt, all those other things. So we built a relationship over the course of the last 3 years so that our team doesn't have to. Our partners, they don't have to, right? So we can create a arbitrage on that one. The second thing is the property strategy implementation. To us, everybody knows how to run an asset till you give them an asset. We have seen that fair share of the last 2.5 years, but for us, we have a process that we kind of use, and that's what we're using it for most of the takeovers, and that's also happened after investing 15 times. Last one is the best-in-class tools. We believe tool first, human capital second. So whatever that we do, it's based on the tool. So our tech stack, it's like that we built it up. So whole idea is that if you're an LP, you're trying to grow, and you have a syndicator coming and say, I'm a $50 million, $100 million asset, you ask the question, what's your process? What happens if you get sick? What happens if you go to Hawaii for vacation for 6 months, right? Who runs the asset? So you should look for a syndicating team who's big enough. They have full-time employees, they have process, they're running a business. right? And if you're a general partner, you're coming in, you want to grow. That's what the growth looks like, right? Once you hit a certain number, to have a team and a process and a tool, that becomes a business that you can run, where it allows you to go out with your family and allows you to hire in more employees. So that becomes a true business as you kind of go. That also helps you meet the fiduciary duty for your LPs, right? So that's the process that we follow. So interesting for all of us. We like to test and break things, high intensity stuff. So what we do, everybody who comes in our program, they go through everything almost, right? You run 20 to 30 deals, different type of deals. We make it very uncomfortable. Then we let you go through all the negotiating that we do. We tend to send out 2 to 3 LOIs a week. So you see the LOI process. We negotiate almost all day, every day with someone. So you get to be a part of it. And then we go through the whole process, then you would take a test. And then you decide what's your path, how you want to come into the multifamily side. Do you want to be an LP? Sometimes we have folks here who are great at everything, but they have a constraint, which is they have committed 60 hours of their weekly time somewhere else. So even though they want to be GP, the time doesn't allow. So we can design it, say, hey, you can be an LP and still get the best out of it for now as you build up your whole timeline, or you can be an LP and a GP in a different way. So once you take a test, we typically give you a feedback on 3 ways. First one is the deal finder and acquisition specialist, that you become really good at a location where without owning the asset, you underwrote so many times, you know what does it look like, you know what the characteristics of a good or bad deal looks like. So you can kind of smell the good deal, right? So that's what we do. We give you guys databases and process, and that becomes really a mastery on that. Second one is the fund manager or capital raiser. If someone said, hey, I want to start a capital raising, we give you a pulse of the acquisition first, because I could raise money, but how do I know where to deploy? How do I know whether it's a good deal? How do I underwrite the deal team, asset management team, and the deal itself before I say I am a manager of a fund, so I can really deliver my fund to a different place. And also we show you on the back end what happens, so that you can, once you raise the fund and deploy the fund, you can manage the fund for the next 5 years, right? And the last one is the asset management. That's to us, to be a good asset manager, you got to be a good acquisition specialist, you got to be a good fund manager, and then you got to be an asset manager. That's because an acquisition sets you up how to run an asset. So if you don't know what assumptions were made, it's tough. And also fund managers, how we stack the capital tells you what your boundaries of delivery looks like. So you got to know how to set up the boundaries. And then you will have the baby for 5 years. All the beautiful things will happen. So that's why for us, asset management is it is one of the best thing you can learn. And to get there, it takes a little, type of specialty, database, and simulation. And all of them we show and practice during our 2-day seminar that we have. So that's that. So let's get into tax. I love this one. Everybody will say government is the worst enemy. Till you need a friend. I know it's a different one. It's a government is the worst enemy. Everybody will beat down government. Till you need a friend. And now the question, remember, everything is unfair. Question is, it's an open book test. I always say it's open book test. Whoever studies more gets to understand what does the book say, and you apply the rules for you because you studied more. You should get extra benefit out of it. So government has done a lot of things for us that we could use and make government our friend. And if the government becomes our friend, we get the best process and system and the one of the biggest powerful thing working for us. So that's the way I take a look at it. And so in this case, I thought the best way will be we'll do a simulation of a case study. And this is month number 7, no, almost about 8. We have 4 months left. Most of us, we know what your earning of this year look like. And then we'll ask the question, is there anything we can do to optimize the tax, right? Or my taxable income. All right, so that was my thought, the things we're gonna cover: example of taxable income for family, framework of a tax optimization, then live case study. I have Bill with me today. 1 and 2 I'll cover, and the third one is out there. Full disclaimer, hey, don't write off everything. Please don't. So some folks want to write off everything. So just be careful, talk to your CPA, accountant, and get some counseling before you start writing off. I thought that was kind of fun when I took a look at it. My wife gets freaked out every time I talk about, can we go out for dinner? You and I, it's 2 business partners. She was like, are you going to write that off? I was like, hey, so that's out there. All right. All right, let's go take a look at it. Again, this is purely fictitious numbers, and it's for educational purposes only. I messed with the number as much as I could. And thank you, Bill, for finding an error in the calculation, but I will move forward with that error. So whole idea is that when you do your taxes, at the end of the day, when you submit it, you get a 1-page document. I forgot that's the first page of tax that gets you 2 years of income. So I took that model and I said, hey, we have a couple married filing jointly on top, and their tax bracket was 24% in year 2020 and 35% year 2021. The income was $140,000, went down a little bit to 125. The other income doubled almost, went from a 337, that's a 237 to 450 almost. I'm rounding it up. So in a sense, in a year-to-year basis, they went up from a $300,000 of dual income and to almost $600,000 of dual income, right? So just income. They worked hard to a point. The business income went up and their salary stayed. Probably one person owns a business, the other person works at a corporate job, probably the salary plus a bonus, whatever happened, right? That's the simulation. So the adjusted gross income was 300 to almost 600. So they had an increase of 186% of income. Before I get to the middle of it, I'll look at the bottom. So they have done something there. Here, you can take a look at it. They have a deduction, state standard, but here they had a qualified deduction and they had no deduction on 2021. So year to year, the deduction went down, right? So then look at the taxable income. So they made 300 gross level, went up to 186%. So their tax burden went up almost 3 times. So look at the very bottom. They made 305, but they kept 300. Because of the deduction, the way they set it up, they paid only $5,000 tax. On the other side, the year after, they worked more. They worked harder. They doubled the income almost, but they took out only 423. So even though their gross level income went up to 86%, they took home 141% increase. So the point is, sometimes working hard is great, and then you got to be work smart as well. And that's why we need people like Bill to make sure that they give you the advice, right? So we always say, my mentor used to say, or she says it, first you make it, then you pay the bill, and you feel bad and you cry about it. So then you go back and again optimize that, right? So the question is, in 2022, if the family were to go back, do a planning, or we are in 2023, our projection looks like we'll be making a certain amount of money. My question is, what can we do now? What else we can do given our earning? It's almost there. What else can we do in the deduction level that could potentially put us in a path where I will be paying tax, but at a later time, not today. So on that note, everybody pays tax. Our goal is not to pay tax today. We'll defer the tax. So whatever tax avoidance, I don't want to pay tax make it 0. That's not true. Everybody pays tax, and it's like you just don't want to pay today. That's the whole idea. I'll kick the can as long as I can. If you ask Bill, he'll be like, till after you die, you pay the tax. But I was like, I don't want to die. I don't want to think about it. I know it's going to happen one day, but I just want to defer the tax for now, right? So that's the idea. And we'll do a simulation where Bill is going to come back and say, hey, if this earning looks like those are 3 or 4 or 5 things you can do to optimize your earning in the next 4 months as you go through. All right. So those are the framework on the left-hand side. There are other frameworks as well, but most of the things that we understand that fits into those buckets. Possible strategy, and the first one is reduce the taxable income. That means you increase the tax deductions, or if you cannot increase it, at least you maximize it, the tax credits. And then you can also time the income and deduction, or you can restructure the whole investment for your tax efficiency, right? So there are some levers. It's not hard and set right away, right? So all in all, it's going to boil down to you improving your tax knowledge and you working with the tax professionals, right? So our idea here is not to solve, rather give you a thought, or at least a framework, how you can get to number 6 and 7, right? So our objective is to start the number 6 with you guys, then you should take the number 6, get to the number 7, so you can position your P&L of your family P&L to have a lower taxable income, right? So that's there. So on that note, I would like to introduce Bill. Bill knows everything about everybody, including Master Team, A to Z. So he's our top secret guy. We've been with Bill forever. I don't know Bill for how long. So our goal is to, hey, Bill, let's take a look at that existing, the P&L that we have. And since we're real estate, we'll take a look 2 different ways, right? We'll use real-time case study. One case study is the Horizon deal that Trevor was mentioning. Second one is the Harris Rich, the Austin deal, the Harris Rich. We're gonna use them. So I'm an investor. I got Bill on my side. I have 2 deals in front of me. I want to do something with the real estate, and options that I have is this. I have 2 investment on hand, with or without cost segregation. And then question is, what do I do? Do I do both? Do I do one? And do I do none? Or what do I do now so that I can minimize my taxable income and pay the tax years from now, right? On that note, Bill, would you mind dissecting this one in the light of those 2, cost segs and no cost segs, and new development versus existing multifamily, and
Yeah.
spinning your way as well, please.
Yeah, sure. Sounds good. So, hey, good evening, everybody. So I'm Bill Pilkington. And so what we have here often is like an opportunity. It's usually best, especially now. So even though we're, almost end of July, beginning of August, it becomes a good opportunity to kind of look to see what's going forward for the rest of the year. Kind of see like, what else is in your pipeline. And because if you come to somebody like in February, March, sometimes it's too late. The best thing we can do is make an appointment to talk about the current year. But say you've got a good idea of where you've gone for the current year. So kind of looking at these 2 situations here. So one of the best things you've got going is it's married, which means when you're married, one spouse might be the primary earner, which allows the other spouse to become a real estate professional. Now, real estate professional does not mean just you become a realtor or you're in construction. Sometimes it does mean active management. It means sometimes like being a landlord. But what real estate allows you to do is to front load a lot of your losses. Now, for those that are real estate professionals, they get to take those deductions in the current year. So you're offsetting your current year income, thereby reducing your current year tax. Now, that doesn't, if you're a passive, you've actually still got a lot of tax advantages. What happens in your tax advantages, you're seeing here like these numbers, but what these numbers don't represent is cash flow in the sense of what gets distributed from these passive investments. These earnings, when we talk about net tax cash flow, that's talking about gross earnings. Nice thing about a lot of the real estate, we front load your deductions. So then when it starts paying out income, until you recover all of your losses, which for all intents and purposes are paper losses, it's depreciation, you're not paying any tax. And so what that means is you'll really start to see a lot of the advantages from the real estate on the sale. So for some people, it may mean as you buy, you may not be able to save taxes up front immediately, but you're setting yourself up for future benefits. Now, what I like to say too is if you've got say 5 different investments, you start to benefit from the ability of like where you had those other ones, like Troy was talking about, cost seg, no cost seg, because if you've got built up losses, you can now start to evaluate deals like, okay, what type of internal rate of return am I looking at? You may or may not even need the cost segregation. Some of those that are early on, or maybe they had a big sale, they had a big gain, they're looking at those things there. Everybody's situation is slightly different. But what you're looking at is taking deductions up front and holding those deductions behind glass. And that glass says break in case of profits. So what happens is year 1 or year 0, whatever you want to call it, from you get a large loss, and then you start drawing down from that loss. And even though you're getting paid cash flow, you're using the leverage of the depreciation on the property to not pay any tax. And then when that property does sell, and if you buy another one within the same calendar year, you're able to keep kicking the tax can down the road, because the IRS allows the real estate to accelerate the depreciation. It's kind of another way of saying, like, imagine if you had a big log and you put that log on a fire, and that fire might take 27 years to burn. Or you can cut that log in half and then chop it up into smaller pieces. And so you're still the same log, but now you're able to burn off a lot more of that log in the first 1 to 5 years. So you've got this building, but instead of waiting 27 years for your deductions, you start front loading a lot of your deductions. Well, those deductions give you, for tax purposes, a loss. We'll call it a paper loss, which means until you get paid back for all your losses and gains, the IRS is not charging you any tax. So you're able to start getting distributions, able to start getting cash flow without an increase in tax. It's kind of one of those, it's almost like doesn't even show up on the tax return. There are some places it shows up, but it's not one of those incomes, so you're not paying tax on it. It's a little bit of like, okay, you see this, like what you see here, but what we don't always see is, well, what about the cash flow? What about the distributions I'm getting? How much tax am I paying on them? And that's where we talk about in the current year, as you receive them, zero. Now, zero is not the same thing as tax-free. You do want to always keep in mind, again, we call it like defer, 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 die. And so, sorry, I mean, Shar and I like to joke around about that, but last time I checked, except for Jesus, 1 out of every 1 people dies, so I'm not Jesus, and so I know I'm going to die. We'll just use me as an example. So my wife's going to be fine because, like me, myself, I'm also invested in a lot of the multifamily properties across different states. And so what happens, we're getting the cash flow. We invested up front. And I'm not the real estate professional. So sometimes people think they need to go for that. There's a lot of benefits, even just from being a passive. Again, it's one of those, you put your money in, you start getting paid distributions, you start getting cash flow, it sells, you have a large gain, but you reinvest it in more properties, you actually probably increase your cash flow. And again, you still keep deferring the tax. And it's kind of like gross almost equals net. Now, in the event you decide, you know what, hey, this has been fun, let me just cash everything out, there is going to be a big tax bill at the end. But that's, again, one of those, you can plan for it if you plan in advance. I know that was me just kind of like doing a lot of talking. Sometimes people have specific questions. We can talk in generalities too. I'm happy to give anybody an answer here. I just don't know if you want to, in front of everybody else, go, yeah, I make $175,000 a year, I want to invest.
So let's ask this way, right? Let's say me and my wife, right? I'll go back 5 years from now, before. So both of us, we worked, W-2s, and we wanted to invest in real estate. And I want to get some benefit of depreciation. So even though I don't realize the entirety of I cannot front load my depreciation, what else? Is there any benefit of, can I bank them for future terms, or how would that work if I'm working and I'm not a real estate professional? What do I do with the depreciation?
So what it is, you never lose it. It ends up, you bank the losses to offset your future income. So here's a really good example. Imagine you're in 5 different properties and they're carrying a $20,000 loss each. So collectively you have $100,000 of losses. And then one of them sells and you have a $60,000, so $60,000 gain. Well, you think it's 2020, you would think, hey, I may have to pay tax on that because I was carrying a $20,000 loss on this property, and I just sold this property for a $60,000 gain. Most people might think, hey, I got to pay tax on $40,000. But with real estate, you actually get to pool them all together and go, wait a minute, I still had another $80,000 of losses over here. I'm going to use $40,000 of losses from my other real estate properties to offset my current gain. And so it becomes a time value of money. You could walk away with the gain and go spend it on personal and you're fine, or you reinvest it in another property, and now your other 80 of losses that went to 40, you start to create new losses for yourself. And again, defer, 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 die. Now,
okay,
that's if you only focus on the real estate. Sometimes also we do the tax planning, like going back to the scenario of what you had, where we see the things like, okay, hey, we lost the qualified business income deduction. Well, maybe we look at that Schedule C and convert that over to an S corporation, and we start paying payroll. And then maybe even what we do is you now start saying, hey, you know what? Not only do I want to take a payroll, I'm going to create a 401k account, and I'm going to use my 401k to invest in the real estate. there's different opportunities based on the individual situation. This one in particular had good self-employed income that you could use things like that. But maybe one of the people in this situation is like, hey, what would it look like if I didn't even, I dropped my W-2 income, become a full-time real estate person managing properties, that now all of a sudden there's cases sometimes tax goes, close to zero. It goes close to zero this year. Again, we're deferring it till later. But in the meantime, now you've got advantage of your money now. You're taking your cost segregation depreciation now, investing in other properties, and you're really just setting yourself up, for lack of a better term, for an early retirement. A good retirement,
cool.
not the permanent retirement of the die. This is a good retirement.
So let me kind of recap, right? So let's say, going back, every year we invested one deal, year number 5. I have carried over $100,000 worth of your total loss, right? And then the first investment came back with a profit, $50,000. So I have $100,000 worth of loss and $50,000 worth of gain. I still have a net of negative $50,000 gain, right? Is that right? And then that means I'm kind of deferring the tax. Even though I had a gain, I'm not paying the tax. It's offsetting my stuff. So it's just timing the income and deduction, right? Is that the way?
That's accurate, because you have to, until you recover all of your losses. Now, I'll make one qualification. I am talking about at the IRS level. If we get down into individual states, it's the same thing, but you need to zoom in with Google, like, hey, Texas sometimes thinks it's the only place in the world, but so Texas doesn't have the state income tax, so you don't have to worry about that. But say you've invested, like I've got some in North Carolina, some in Georgia, some in Oklahoma. If those states have a profit at the state level, I'm not offsetting my taxes. But at the national level, at the IRS level, I'm using the losses from one to offset the gains from the other.
Cool. Now, same scenario where one person has a W-2, other one is a real estate professional, and they have $100,000 worth of loss and $50,000 worth of gain. So what really would happen, they'll get the benefit two ways, right? One benefit is that there's no gain because I'm still a net loss. And then if they could realize the whole 50 grand, I'm thinking right here, if I'm a 35% tax bracket, I take a 50 grand worth of deduction, I'm at a 24% tax bracket. All of a sudden I gain another 10%, right?
Correct. Yeah. So what we're doing now is we're getting the time value of money. And so instead of waiting to get those deductions, we're deducting them in the current year, giving us more cash flow in the current year. Then, it kind of sometimes becomes like the snowball effect. Again, because if you get something now, it generates cash flow. You take that cash flow, those losses, buy them into something else. And then, maybe 10 years from now, you're paying taxes because you've used up all your depreciation. You've used most all of it, but you've got much better cash flow that, the taxes are not as big of an issue.
So you kind of stack them together, timing income deduction, and also you're paying the tax whenever your tax bracket is lower, or you created a scenario where tax bracket is lower, so you're paying the deduction, income tax level lower, plus you also timed it, right? Now,
Correct.
This is interesting. This is awesome. Now, let me go back to that chart that we have here. So hold on, where we at? Okay, this one. So let's see, which I'm just sharing my thoughts based on what I do understand. I know the couple, by the way. So numbers are fictitious, but it's there. What they have done next year is they took that one and they created an S Corp. And then the S Corp, they took a salary and they had a 401k match all the way. How would that benefit in terms of maximizing your deduction or tax credit when you get an S Corp and you take a salary and you get a 401k set up?
Yep. So what happens is when we convert them over to the S Corporation and they start taking a salary, that begins to make them eligible again for the qualified business income deduction. The previous case, because their income, it was below $350,000, they automatically qualified. And so what it is, some people call it the Trump tax cuts, some call it qualified business income. At the end of the day, it's like a coupon, 20% off. So you can take 20% of your business profits and take them as a deduction. When on a married couple, as income starts going over 350 or singles over 175, they start to have qualifications on it. Hey, you need to take payroll in order to get these deductions. Doesn't matter who you pay. You can pay yourself. So you pay yourself the paycheck, and then you're able now to get a double deduction because it's just it's a coupon, and there's no tax ramifications. Much like if y'all use a coupon, you go to the grocery store and you get, $5 off your groceries. Nobody's taxing you on that $5. That's just, you got a free $5. But then now you take that on top of that, you maybe take some of that, you create the 401k. Say you create a Roth 401k. So you're not going to take a deduction for it. Again, forward thinking. Why would I want to put something in? I could get a deduction today and not, or maybe not. Now, everybody's situation is different. For some people, it works better than others. We kind of craft them individually. But with a Roth 401k, now you put that money in, like we talked earlier about that 2.21 multiplier. So whatever you get in, you're now going to get 2.21, your original 100 back plus another 121 tax free, like free, And so when you're turned 59 and a half, when you retire, but that's one of those now tax free, the tax bracket on tax free, 0. So yes, you're paying tax today, but for 0 in the future. Now, the thing is,
just a quick clarification, right? If you're doing any retirement plan, it's just deferred tax. If you do a Roth, you pay the tax now, but everything that you earn in that account is tax-free until ever.
Correct.
Yeah.
And so that's where sometimes, and it's not always appropriate for everybody, but it is appropriate for certain people. And as long as they understand what they're getting into, again, this is where it kind of comes down to like more of a one-to-one relationship, kind of doing your tax planning. And the reason I say sometimes people say, well, I'm going to retire in a lower bracket. I hope so. Challenge is, I looked at my crystal ball and said, hey, what's the tax rate in the year 2034? And it says, come back in the elections of 2033. So I know what 0 is. 0 is 0. Maybe we retire lower. I mean, it wasn't that long ago. Well, some of y'all on the call look really young. So us old dinosaurs, Ronald Reagan went crazy. He dropped the top tax bracket from 70% to 35%. So if y'all just think about stuff like back, prior to the 80s, which was actually the 70% came from when JFK went really crazy. He dropped the top bracket from 92% down to 70. And so a lot of people on this call probably can remember times like that when taxes were that high. And so it's not out of the realm that they start dialing the taxes up. So sometimes maybe you don't put all your money in there. You kind of couch it, do a little bit of both. Or you could do the pre-tax 401k. You could do pre-tax IRAs, things like that to start, again, taking some advantage of the time value of money. The important thing, what I'm saying here is everybody's slightly different. Let's look at your situation. But imagine you're just 2 W-2 people. You don't have self-employed business. You don't have anything else. And you start investing in real estate. You're like, well, why should I even do this? It's because you're able to start deferring money. I mean, because when you retire, the truth is, it doesn't really matter what your rate of return is when you're in retirement. What matters is you don't want to run out of money. And so you want that cash flow. You want that consistent cash flow to keep coming in. And if you can get a lot of that cash flow without having the tax drag, because as you see, is the more you make, the more they take. But as you start getting some of this cash flow in the future from these new deals and you've deferred a lot of your taxes, you may not have to make as much. I mean, again, $7,000 with no tax is the same thing as $10,000 with 30% tax. That's where you're kind of going. And again, defer, die.
Bill, say it one more time. It's like
let's clarify the
$7,000
die too. You get to pass it on to your heirs at a stepped up value. So I'm the oldest guy here probably, so it's a big part of my plan.
Now, community property states like Texas, the spouse that inherits it is getting unlimited, infinity tax-free, the step up. So if 2 spouses own it in Texas or other community property states and one spouse dies, the surviving spouse is not inheriting any tax bill. In non-community states, they will receive half of it, unless it's owned by one person or the other. But if it's owned jointly, half of it steps up. If both people die, or say it's a single person and they pass, whoever inherits it Like right now, the first 12.5 million is tax free, married, the first 25 million. Now, some of that's just also different tax planning. Again, everybody's situation is slightly different, but generally speaking, those that take after you, they're probably not going to be picking up a tax bill when you own it outside of your 401k, outside of your IRA.
Bill, to kind of build up on that, right? Let's say on a W-2, you don't have anything and you got a couple of kids. At least from my side, we can hire our kids for a side. I mean, we live in a gig society. Everybody got something cooking, some way, shape, or form. If you can LLC-fy that, establish that, you can always hire your kids. So I have 2 kids. They work for me. They really do. And I make them work. Don't get me wrong. And then the way I take a look at it, I have a college fund, right? And versus them paying it. Going back to what Bill was talking about, if we pay them $10,000, right? Or if it is same as paying them $13,000-14,000, that's because I am saving the tax bracket money, right? So that itself is a return. Look at your college fund, how much to make? 5, 6, 7%, they follow index.
Oh, yeah.
And if you expense go ahead.
If you're paying for college planning is retirement planning. I mean, it's cash flow. Now, the one thing you said, make sure everybody heard that. They actually do work, just because
They actually do work. I'm just saying,
kids,
yes, they actually do work. They report to me. They have roles to play, and they actually do work. So I'm not saying take shortcuts. I'm saying do the right thing, make them work. It's a life lesson for them. But just imagine it's for our business, it's an expense, and just because that's an expense, it's a salary to them. There's a 30-35% gap. Where in this world I'm going to get a 35% almost guaranteed return in the equity fund? There is nothing that I know of, right?
Oh, yeah.
Because, I mean,
and then
so just because.
Depending on, like, again, if you're self-employed, now this goes back to, like, say, like in that couple before, they were self-employed. Maybe they have 2 businesses, some self-employed, some S corporation. Because actually, so self-employed, no LLC, no corporation, no LP, and basically there's truly self-employed, and their kids are under 17. The kids don't even pay Social Security or Medicare tax. And so now all of a sudden you're paying them income. The first $12,000 the kid earns is really tax-free anyway. So, get them to work, but then say they put that money into some type of Roth. Now the kid's putting the money in a Roth, or the kid's putting money, you do something for college planning. You're just totally setting yourself up for more benefits in the future. Again, sometimes you got to think 3, 5, 10 years ahead. But one thing I'd say about, like, first thing I do in that, this is like my own personal experience. You can look around for investments, and I'm not telling you which investment to do in, but it's one of those, you got to get off, I'm a gonna, kind of like 5 frogs are sitting on a log and 3 of them decide to jump. So how many are still left? Well, 5. Just because 3 decided to jump doesn't mean they actually did anything. So it's one of those, you have to actually do something. But in the event you get into these multiple investments, it's very good in your first one and second one, or if you're about to sell one, cost segregation, depreciation becomes very important if you're about to sell. But if you've now built up a portfolio of losses, you have the flexibility of deciding, hey, you know what? This land deal has no depreciation, but is going to make me some good money. I already got enough built up losses. I can go in there. I don't have to do the one with depreciation. But then again, maybe you sold something at a large gain and you're like, you know what? I need a lot of depreciation, because many of you have heard of like a 1031 exchange. That's kind of like where you give up one piece of real estate and you buy another, you don't pay tax. But something we see a lot of, it's called a lazy 1031. A lazy 1031 is, I sold something at a gain, but I don't want to pay tax on it. But I'm now going to invest in this LLC. And so I can't 1031 my money into it. So what do? Well, if you get into this new LLC, and this LLC creates losses from a lot of the depreciation, the cost segregation, the bonus, if it all happens in the same calendar year, you can use the losses from your LLC investment. Like maybe you sell a bunch of your single family properties to get into this LLC. You can offset your gains with the losses that are generated from your passive investment. Again, this is like when everything's passive, apples to apples.
100%. Bill, Thank you. I know we're top of the hour. I'll leave you with two things, right? Underage kids, the biggest issue with underage kids that though they cannot sign contracts, but we want our kids to invest, and they may have to sign contracts on behalf of that. So if you stack up, and if you got people like Bill who could say, hey, find a way to get your kids working for you, really working for you, like literally, and then give them a salary, they get them a Roth IRA, and then once you have a Roth IRA or IRA, two IRAs can buy together, same side of the table. All of a sudden, your kids, our kids, they can buy investment, they can own it via the Roth IRA because that's a custodial account, right? So point is sometimes it's how, sometimes it's who. In this case, who is the best way to go? So number 6 and 7, please, engage, especially number 7, find your who, talk to a tax professional, ask them deliberately the question, this is my income this is what I think I'll be finishing my year with, what the best thing I can do. On that note, your bias will matter. If I find the cheapest guy, all they do taxes, they'll give you that kind of an answer. If you go to a person who's doing real estate and other tax strategy and things like that, they'll give you that type of answer. So qualify your folks that you have, please. I love those CPAs and everybody else that do your taxes, but that fixed flat, I get to you 2 days before the tax, they're not the type of people you want to do. You want to ask your professional, do they do tax strategy? Have they done it before? Folks like Bill, and find your person, go engage with them. And the last one I would say, what I always crack a joke out of it is this: income versus taxable income. Thank you, everybody. I'll stop sharing. So if you guys have any questions, please continue. We have, and after 7 o'clock, we still continue. And Mike, I would like to pass the rein to you, and I have that Horizon LP Investor Quarterly meeting. I'll jump off to that one. Thank you, everybody.
Just stop sharing. Yep, we're
Yeah,
back.
yeah.
Good. Awesome. Thank you.
Thanks.
Awesome. Anybody learn anything? I hope you did. Feel free to ask any questions. I'm happy to volunteer Bill to answer them. Well, we got a quiet crowd tonight.
The one thing I know a lot of people ask me about is they want to invest through their IRA. Completely fine. There's something called a self-directed IRA. You'll find there's a good custodians. You'll want to make sure that you get with them. You transfer your IRA over to that person, that entity, and then they will invest through the investments for you through your IRA. So it's okay. It's called self-directed IRA, which are a great way to invest. You just have to remember one thing. When you invest in a self-directed IRA, it's kind of like it's its own corporation. It may owe tax on some of the profits, but remember, you're only paying tax if you had a profit. And taxes are still less than 100%. It's like 20%. The IRA will file its own individual tax return. And so upon those profits. So it's just one of those, just to kind of understand something if you do it. And that includes Roth IRAs, pre-tax IRAs, SEP IRAs. But they're a great way to invest, a great way to help defer a lot of those taxes there.
So we have a question and I don't understand it. So a 403B and a 457, I'm not sure what that means.
Yep. So
I thought those were engines or something.
giddy up 409. So a 403B, that is typically what a nonprofit, that's the 401k for nonprofits. Many times you'll see that in hospitals and other types of not-for-profit entities. 457s are what you do for governmental entities. And so it's the same, again, most people hear 401k, but like churches, hospitals, actually some hospitals, when they're owned by schools like University of Texas, they'll actually have like a 457 and a 403B. So I think the question is, can you use that money to invest? And so if you are a participant in an employer-sponsored plan, they would have to have the self-directed option available to you. Typically, so when you form your own company, you're a for-profit company, you'll have a 401k. So you wouldn't have a 403B, 457. Now, maybe what you do is you roll your 403B or 457 out into an IRA, and then you invest. 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 And then you and then you use your IRA to do the investing. Now, if you cash out, which is fine if you cash out, but if you cash out of a retirement plan and you're under 59 and a half, you very well may likely not only have to pay tax, but you'll have to pay the 10% penalty. Now understand, the tax on that income, if you invest in a real estate deal and it creates a loss, you cannot use that loss to offset the income from your 1099, the distribution from your retirement account. And I understand people will say, well, I use that money directly to buy it. They're related. Much the same way if you have a job with a W-2 income and you're using the W-2 income to invest in real estate, you can't offset that. Now, if you're thinking about that, or actually some people now say maybe they don't like the performance of their current 401k, their current 403b, their current 457, but they don't want to quit their job. They're like, well, my company's telling me that I can't get the money unless I quit. I don't want to quit. There is something called a qualified domestic relations order, or they call it like a quadro. Not every state allows it, and not every company allows it. Like if you work for the government, so some of the 457s, like if you have like a thrift savings plan, if you work for the federal government, it may not work. But in the right case, what happens is you hire an attorney, it's about $5,000. They draft up an agreement. Now, you don't have to quit and you don't have to get divorced. Usually you'll hear quadro, they automatically think divorce, no more. What that allows you to do is say one spouse has the 401k plan, they erase that spouse's name and they fill it in with the other spouse's name. Now that other spouse, because they were not the one that originally earned it, when they cash that money out, doesn't matter how old they are, there's no 10% penalty. And so it's a way to access funds from inside your company retirement plan without you quitting. I had a couple of other ones. I had some Continental, United pilots, and they had a plan, but even though they may have been over 60, they were still working. And so they weren't going to be able to access the funds until they left. So it wasn't to avoid the under 59 and a half penalty. It was just to tap into the funds. They did the same thing, did the quadro, transferred it to their spouses. Their spouse gets to cash the money out. And so it's a way to access your money while still working. Just, it's an option. Sometimes people are like, hey, I like these investments, but all my money's currently tied inside my company retirement plan. How do I get it? They're telling me I can't get it unless I quit. And so there's other options available to access the cash.
Awesome.
Actually, I say cash
Hopefully
out.
that answered your question. If not, you feel free to unmute. Kevin, go ahead, sir. You should be able to unmute yourself. There you go.
So I have a 457. I can't touch it until I leave, which will be in a couple of months. But I would have to, they said I would be able to take it after I'm retired. Does that mean I can only do it after 59 and a half?
So what they're probably referring to is, so if you retire, they call it like a terminating event, which means like you can even voluntarily retire or quit or get fired. When you leave, like you're no longer actively working, the restriction to access that cash goes away. Now, if you've not turned 59 and a half, now depending, some things, so like there's certain things like public service, police, fire, EMS, they're able to take things out at 55. There's different rules that apply. 59 and a half is the standard deduction, but it doesn't necessarily apply to everybody. But so certain first responders get an additional exception. But if you could cash it out, you could roll it to an IRA, or you can do a little bit of both, different tax consequences. Now, if you're living in New York as you do it, you're going to have New York tax. And if you're in the city, one of the boroughs, they're going to hit you with the tax on the borough. If you were to move to a non-income tax state and then take the money out, you would not have to pay the state income tax. Different rules kind of apply. I don't know if that makes sense.
Yes, it does. Well, I work for New York City Fire Department. I live in Staten Island. I can leave at the age of 50 because I'm paying physically taxing. Um, will I be able to take that and roll it over to my wife?
So you could, if you wanted to, trying to make sure I remember the rules for like FDNY. If you could, hold on. And so I know the rules on 401k. I think they're going to apply. So public safety, let's see. So let me just verify that. I mean, I can get off those, but I believe, let's see. Nope, after 50. That's what it was. I was thinking it was 55. It used to be 55. So if you wait till after 50, 50, after, so your first responder, FDNY, you don't have the 10% penalty. So you don't even have to give it to your wife.
Okay,
You are
okay,
from the 10% penalty.
okay. But I would still have to pay my regular taxes on it.
Everybody has to pay the tax on it.
Okay.
You're all,
Now,
that's sometimes.
Would I be able to, I can't avoid that by rolling it into real estate?
So what you could avoid if you roll some or all of your money into an IRA, then you now are able to do a self-directed IRA. You can take that IRA money and invest it straight into the real estate. Now, if that real estate you invest in carries a mortgage, if that real estate has a profit, you're going, when I say you, what I actually mean is your IRA will pay tax of 20% on the profits. So you roll 100,000 in and it doubles to 200,000. It's very possible your IRA could pay up to $20,000 of tax. So instead of going 100 to 200, you go from 100 to 180.
Okay.
But
Now, I
that money
also
comes out of your
have,
IRA, not your pocket. It comes out of the IRA. So like if you use Quest, Equity Trust, American IRA, there's many different very good companies. They send the money to the IRS for you.
okay. Now, I also have an annuity that has over $500,000. I roll that over into a self-directed IRA because I can't leave it where it is because they'll continue to charge me fees if I leave it there.
Yep. So make sure, force the, like some annuities, they're different ones. Like, so I don't know, like in the city pension one, they're like a Texas or something called TRS, the teacher retirement system. So some annuities, it says $500,000, but that's the annuity value. The cash value, insurance does a lot. Like if you cash it out, it might be less. If you roll it to an IRA, it may not be the full amount. It might be less. Now, that being said, because it might still be worth it. It might still be because, hey, you're, again, like, I don't guarantee any returns. I'm not like, so I don't work for Massive. I work with them, but not for them. And so you then make that determination of, hey, this investment makes sense for me based on, okay, I'm going to get more money based on this than I'm going to earn inside the annuity.
If I'm getting 20%, yeah.
Yes. And that wasn't me saying yes, wasn't me saying no. I'm just kind of saying, that's sometimes what people use for their determination. But rolling it over, because it's like, I'm assuming it's like a pre-tax annuity right now. So you roll it from one to another, you roll it to your self-directed IRA. It never touches your hand. So you're not paying tax on it. And then it gets to invest directly in properties, which is nice because say it's $100,000 minimum investment. Well, you only need to invest the $100,000 into it. You don't have to cash $150,000 out, pay $50,000 of tax today to then invest the 100 later.
Okay.
And then with that, now with all IRAs, then you name who's your beneficiary. Typically that becomes your spouse, but then you could have like a contingent beneficiary. So that's all part of the IRA setup. And so some people understand, if people just understand an IRA in general, a self-directed IRA is still a regular IRA. It's just held with a custodian who understands how to invest directly into real estate. Most IRA custodians only understand stocks, bonds, mutual funds. They understand better how to do real estate.
Okay. Thank you.
Yep. And then now the IRA, I said it'll be like its own corporation. When it makes a profit, it files a form 990-T. Now, if you do a Google search, you'll see IRAs don't pay tax on passive investments. It's not the passive investment and it's not your cash portion. The tax is that, I'm getting kind of like CPA geek stuff here. It's the mortgage on it because you're making a profit on borrowed money. And typically they say IRAs are not allowed to borrow money. And so it's really not, and they call it like unrelated business income tax or UBIT, but it's really called UDFI, unrelated debt financed income, because the income you got came, some of it was leveraged with the mortgage, is why they can justify charging you a tax, but only on the mortgage portion. That's why, like when you have stocks, bonds, mutual funds, you don't pay this tax. It's because you're just using a cash investment. It's you borrowed money. But again, first off, you don't really pay. When I say you owe money, that means if you put the money with, say, Quest, and Quest receives all your cash distributions, they pay the tax for you, on your behalf, and then from your pool of cash.
Now, if I'm on a deal and I get in on it as a GP, and I take money from that and I put that into the LP side, I could be collecting from both sides, correct?
So there are rules on your self-directed retirement funds that they have a lot of restrictions. You cannot be a managing member of that. So you could invest it on somebody else's deal as a passive investor,
Okay.
but they can't be used on your own deal.
100%.
I
Yes.
thought I heard that I can do that, but I cannot own more than 48% or 49% of the property.
You can't even give it to your kids or your wife's properties. There's a lot of restrictions, and again, you need to
I
consult
understand that, yeah.
your custodian. Yeah.
Yeah, they're called self-dealing rules. And so IRAs, if you have any type of management authority, like any type of GP interest, it just voided the ability for you. You can't use IRA money in anything you have a GP interest in. It has to be a passive or an LP interest, even 1% or 0.1%. I don't make the rule.
Because I was talking to somebody from Madison Trust or something like that, and this gentleman turned around and said, "You could do that, but you cannot own the majority of the property."
Maybe they're saying something. I can tell you my advice from how I interpret the tax code and the other CPAs. If you want zero general partner interest. You want zero.
Okay. All right.
Yeah.
All right. Thank you.
Yep. Awesome. This was awesome, Bill.
Yeah.
Hope everybody enjoyed it.
See, Dirk had one question. Distribution. Now, if the distribution was into another IRA, you're good. But if it comes out of the IRA, so you're paying after tax, that now just becomes just like any savings account. So you can use that to put into an LP deal. Unless you're talking now, if it's an inherited IRA and you want to use your inherited IRA to invest, you are allowed to. Just don't forget, there's usually a 10-year clock. And if that clock started 3 years ago, that means you have 7 years to cash out of that IRA. If it started 5 years ago, you've only got 5 years. If this deal doesn't sell till 6 years, 5 years into it, your IRA just converted to a taxable event.
Ah, okay.
That's on an inherited IRA. If you inherit one, that's completely different. The 10-year clock is only someone passes away and you get their IRA. Basically, the IRS says, hey, no problem. You got that money. You got 10 years to cash it out.
Awesome.
Okay.
All right. This has been fantastic. Now, I want to make sure before we leave, we do this every Wednesday at 6 o'clock. If you learned anything, if you had any fun, I want to see you back next Wednesday with a friend. We're actually going to be doing a pretty cool case study on a live deal. We're going to analyze what does it really mean when you buy a value add multifamily? What are the things that you need to do? Because again, if you don't implement your 5-year business plan, investors are not going to make the promised returns. So we're going to look at one of our deals, a live deal. We've owned it for a few months, and we're going to share all the different things and going on and what's happened. And I'm going to be honest with you, it's not all perfect, but we want to make sure it's a learning event, right? Because everybody, this is the whole beauty of what we're doing, right? We're buying a business that's backed by a real estate asset. We're improving the net operating income and selling it for a multiple of a net operating income. If we don't improve the net operating income, we're not going to be able to achieve the plan. So it's going to be a really good deep dive into a property. We're going to show you some of those back end tools that we mentioned that we use for our mastermind students. So it'll be really good. I expect to see you all with a friend. And if you don't have a friend, book a call with me and I'll become your friend. So awesome. Any other questions? We're just about getting done here. Yeah, and I put the link in there. You can book a call and it will pop up all the names of the massive team. And again, Bill, always a treat having you here. Go to our YouTube page. This is like, I think the 5th or 6th time you've been here. They're all recorded, all saved there.
Oh,
And every one of them is full of nuggets.
oh, and then I don't know, you made, Trevor, I was trying one last poll before everybody got out, but if everybody, you guys can just drop some of your, quickly, it's a one question poll, so it's a really easy one. Appreciate the feedback. Bill, always awesome. Thank you for everything that you do and with us as well.
Awesome. Thanks, everybody. Thanks, Bill. We'll
Thanks,
see you
Bill.
all next week. Awesome. Thanks very much. Take care, everybody. Good to see you all. Thanks, Bill.
Did Bill leave?
Yeah, I think he left.
Oh, okay. I had a question for him, but that's okay.
All right. Talk to you later, Mike. Thank you.
All right, bye, Trevor.
All right, we'll see you, Mike.
Hey, Armando.
Hey,
How are you doing, man?
doing good.
What are you working on right now?
What am I working on? Just trying to get this gentleman funded for some gap because he was short on a capital raise. So just trying to get everything together for the PML. And so due diligence, when they're like due diligence, we need a due diligence. I'm like, can you please send me a list of the due diligence you need? And I was just in the dark. I'm like, okay, I think they want this. And I'm like, let's just do credit checks and give me everything. And before they ask me, because it's just communication is a little delayed. But other than that, just trying to get in and hopefully start capital raising for you all soon.
Okay, yeah, I was gonna, because you have so what you're working on, where are you trying to get funding? Like on just some people you already know for like a gap fund or something?
Oh, for that, did you want this to be on record or off record, Mike? Because I think we're still being recorded.
No, we stopped recording.
Oh, did you? Oh, okay. Yeah, still